Welcome back to Talk Tickers. This is the deep dive for the buy side, by the buy side.
Yeah, we're glad you're here with us.
We are here to strip away the corporate gloss, ignore the press release fluff, and get right down to the raw numbers and the real narratives that are actually moving your portfolio. Today is Monday, February 23, 2026.
The markets are officially closed.
The closing bell has rung, and we are wasting absolutely no time breaking down what might be the most contentious print of the entire earnings season. We are looking at Hims and Hers Health. Ticker symbol, Hims.
And if you are sitting in front of your terminal right now, you might want to pour yourself a drink.
Seriously.
You are looking at a sea of red in the after-hours session. The stock is down roughly 2.8 to 3%, hovering right around that $15.16 handle. We have seen about $0.50 erased from the share price in the last 30 minutes alone.
And the volatility is still kicking.
Oh, it's jumping all over the place.
It is the classic earnings season roller coaster, isn't it? I mean, we've seen this movie before. It's the good quarter, messy guidance setup.
Always a painful one to trade.
They come in, they beat on the bottom line, they practically meet the top line, everything looks decent in the rearview mirror, but then they drop the outlook for Q1 2026, and it absolutely spooked the algorithms.
It did. And honestly, it isn't just the algorithms tonight. I think there are some human traders sitting at their desks in Connecticut and New York scratching their heads right now.
Definitely.
This is a complex story because on the surface, the growth engine is still humming. But when you look under the hood at the guidance, there is a very specific, a very expensive operational shift happening that is causing a massive amount of friction.
Exactly. We have a ton to unpack here for you today. We're going to get into why a change in shipping logic of all mundane things cost them $65 million in guidance.
Such a wild number for shipping.
We also need to talk about this massive, and I mean massive, $1.15 billion bet on Australia and Japan.
Huge capital allocation there.
And perhaps most interestingly, we need to discuss why management is frantically trying to tell investors that weight loss drugs, the GLP-1s, are not the whole story.
That narrative shift is palpable. It is full-blown defense mode right now.
It really is. But before we get into the strategy, the defense, and the geography, let's ground ourselves in the actual math. Give us the results snapshot for Q4. What did the print actually say?
Right, let's look at the headline numbers for Q4 2025. Revenue came in at $617.8 million. That is up 28% year over year.
Okay, robust.
Yeah, now technically, if you want to be a pedant and split hairs, it missed consensus by a hair, about 1.4 million.
A rounding error for a company this size.
Basically flat against expectations, yes, but still showing that robust 28% growth.
Which, let's be fair, in this macro environment where we are seeing consumer softness across the board,
Right.
20% growth is nothing to sneeze at. That is still hyper-growth territory for a consumer health company.
Absolutely. It's impressive. And the bottom line looked even better. GAAP diluted EPS came in at 8 cents, which was a solid beat against the 4-cent expectation.
So they doubled the earnings per share forecast.
They did. Adjusted EBITDA landed at $66.3 million, which is an 11% margin. Net income was $20.6 million. So let's be perfectly clear here. The company is profitable. They are making real money.
But there is a flip side to the cash story this quarter, right? Something the market didn't like.
There is. And this is something the bears are going to latch onto immediately. Free cash flow was negative.
Ouch.
Yeah, it came in at roughly negative $2.6 million. Compare that to a positive $59.5 million a year ago. That is a massive swing.
What's driving that?
Management attributes this to heavy capital expenditures and investment, which we will get into, but burning cash when you were previously printing it always raises an eyebrow on Wall Street.
It breaks the trend line. And markets hate broken trend lines. But then we have the real uh-oh moment. The guidance. This is truly where the pain is coming from tonight.
This is the air pocket. For Q1 2026, they are guiding revenue to $600 million to $625 million.
And the street wanted what?
The street was looking for something closer to $653 million.
Wow. Okay, so that is a significant miss on the guide.
Very significant. And on top of that, adjusted EBITDA is guided to $35 million to $55 million. That implies margins compressing down to single digits somewhere in the 6 to 9% range before eventually expanding later in the year.
So you have a revenue miss on the outlook and you have margin compression simultaneously.
Yeah.
That is a deadly cocktail for a growth stock in this market.
It really is. While the year-over-year growth is still impressive, that deceleration combined with the guidance air pocket is exactly why the stock is in the penalty box right now.
Yep.
The market hates uncertainty, and this guidance introduced a whole lot of it.
Okay, let's unpack this. Because the biggest question on everyone's mind, the $65 million question, literally is about this shipping cadence. What on earth is going on here? How does changing how you ship a box of pills cost you $65 million in a single quarter?
It sounds totally mundane, but it's actually a really critical look into the regulatory environment they are operating in. Management cited a shift in shipping cadence tied specifically to 503A fulfillment.
503A, we're getting technical early.
Yeah.
Break that down for us. What is the difference between what they were doing and 503A?
So in the world of compounding pharmacies, there are different designations. 503B essentially refers to outsourcing facilities that can manufacture in bulk. They make big batches.
Right.
503A refers to traditional compounding, where a pharmacist makes a medication for a specific patient based on a prescription. It is way more individualized.
Okay.
Hims is moving its weight loss fulfillment heavily towards this 503A model.
So it's more personalized, more individual. I get that. But why does that hurt the top line so badly?
It all comes down to revenue recognition. To stay compliant and nimble with 503A, they are moving from longer duration shipments to shorter, more frequent ones for their weight loss products.
Meaning what exactly?
Previously, they might have shipped you a 3-month supply or a 6-month supply of a GLP-1 kit all at once.
And when they ship that 3-month supply, they recognize the revenue for all 3 months right then and there.
Exactly. You book the bulk upfront, it hits the ledger immediately. But now, if they are shifting to, say, a strict 1-month shipping cadence to comply with 503A rules, they only book 1 month of revenue today.
Oh, I see.
The other 2 months get booked later when those subsequent shipments actually go out the door.
So the cash might still come in eventually and the customer's still subscribed, but on the accounting ledger, the revenue vanishes from Q1 and gets pushed to Q2 and Q3.
Precisely. It creates a revenue recognition gap. You aren't booking the bulk upfront anymore. Management claims this specific change is a $65 million headwind in Q1 alone.
Just from the accounting shift.
Right. For context, this impact was only about $40 million in the second half of 2025, so it is accelerating as they transition more and more customers to this model.
And the spin from management is pretty aggressive here. They are insisting this is purely timing. They are shouting from the rooftops that this is not a demand issue. In fact, they claim subscriber growth in weight loss is still up 70% year over year.
That is their key defense. They are saying, look, the customers are here, they are buying the product, we just can't count the money the way we used to.
But for an investor, you have to ask a hard question. Is this a structural slowing masked by accounting explanations? Or is it a genuine one-time operational reset?
It feels like a convenient place to hide a little bit of softness, doesn't it?
It really does. Oh, it's just the shipping cadence. But if you combine that with the margin compression we talked about, it gets a lot stickier. And speaking of margin compression, we have to talk about the Super Bowl.
Ah, yes. The Super Bowl drag.
They spent big. A 60-second spot, that is not cheap. And that cost is hitting Q1 EBITDA directly.
It is, and management is holding firm on this strategy. They stated on the call that their marketing payback period is still under 1 year, despite the massive spend on brand awareness.
Under a year is still great.
It is, and they view it as an investment in the proactive health brand they're trying to build. But when you combine a massive ad spend with a revenue recognition delay from the shipping changes, you get that ugly EBITDA guide of 35 to 55 million.
It creates a trough, a valley that investors have to be willing to walk through to get to the other side. And judging by the after-hours reaction, the market isn't fully buying it's just timing defense yet. They want to see the reacceleration before they believe it.
Exactly. In a market like this, you are guilty until proven innocent, and Hins just handed the prosecution a lot of evidence with that guidance.
Now let's pivot to the elephant in the room, or rather, the elephant that management is trying to hide behind a curtain.
The GLP-1s.
The weight loss drugs. For the last year, this stock has traded almost entirely as a proxy for the compounded GLP-1 boom. But listening to this call, you would think they were trying to distance themselves from it entirely.
It was a fascinating narrative shift. We call this defense mode. Management is aggressively trying to de-risk the GLP-1 story in the eyes of investors.
How so?
The quote that stood out to me was, "Majority of revenues are outside of the GLP-1 business." They said that multiple times. They really hammered it home.
Which is technically true, but it feels like they are downplaying the growth engine that got them this massive valuation in the first place.
Yeah.
Why run away from your star player?
Two main reasons: pricing pressure and regulation. Let's talk pricing first. Andrew Dudum, the CEO, explicitly mentioned that prices for injectables in the U.S. have dropped 80% over the last 18 months.
80%. That is a straight race to the bottom.
It is commoditization happening in real time. And that puts massive downward pressure on revenue per order.
Right.
The ticket size for GLP-1s is shrinking fast. So even if you are adding tens of thousands of subscribers, if the price of the drug is crashing, your top-line growth gets heavy anchors attached to it. It drags down the overall revenue per user metrics, even as subscriber counts grow.
And then there is the scary part, the FDA, the regulatory overhang.
This came up a lot in the Q&A, and you could hear the caution in the executives' answers. Management highlighted regulatory overhang several times. They actively admitted that the GLP-1 compounded business is actually a small minority of subscribers now.
Interesting phrasing.
Very deliberate phrasing. They are trying to position Hims as a platform that is ready for a post-compounding world.
There was a specific moment regarding the pill their oral weight loss kit that really highlighted this defensive posture.
Yes, the oral weight loss kit. They briefly mentioned pulling it back or pausing it to prioritize ecosystem relationships.
Prioritize ecosystem relationships. That sounds like corporate code for please don't sue us or please don't regulate us out of existence.
It is absolutely code for regulatory caution. It's code for we don't want to poke the bear too hard right now.
Who is the bear in this scenario?
The ecosystem includes the FDA, the big pharma patent holders like Eli Lilly and Novo Nordisk, and the state pharmacy boards. Pulling back a product launch to appease those stakeholders tells you that Hims is feeling the heat.
So the core insight for you listening here is that Hims is preparing investors for a scenario where the easy compounded GLP-1 money dries up. Whether that is due to regulation banning compounding because the shortage is technically over, or simply because supply resolves and the branded drugs take over the market again.
Exactly. They are trying to build a lifeboat before the ship potentially hits an iceberg. They want to be able to say, look, even if GLP-1s go to zero tomorrow, we are still a diversified growth company.
Which brings us to the lifeboat, or maybe considering the investment, it's a speedboat, the launchpad strategy. If GLP-1s are risky, where's the growth going to come from?
Diversification. They outlined 3 new pillars, and they are putting a lot of weight on them. Labs, testosterone, and menopause.
Labs, testosterone, menopause. Okay, let's break these down. Because management explicitly stated they believe each of these can be a $100 million plus annual revenue business. That is a very bold claim.
It is a very bold claim, but they have the data to back up the optimism. Let's start with labs. This is diagnostics. This is what they call the labs flywheel.
How did that work?
The stat of the night for me was this: 70% of customers who take a lab test identify a risk factor that is treatable on the platform.
70%.
Yeah.
So you take a test, and 7 times out of 10, Hims comes back and says, hey, your cholesterol is high or your testosterone is low. And by the way, we have a pill for that right here.
Exactly. It is the ultimate top-of-funnel conversion tool. It moves Hims from, I need Viagra because I have a problem tonight, to, I am managing my cardiovascular risk for the next 20 years.
It changes the relationship from transactional to longitudinal.
Precisely. And to make this easier, they mentioned the Your Health acquisition.
Right, a $150 million deal. That was for painless microneedle technology to bring blood draws to the home.
Because the barrier to entry for labs has always been friction. I don't want to go to a Quest Diagnostics or a LabCorp and sit in a waiting room with sick people.
No one does.
Right. But if Hims can mail you a device, you stick it on your arm, it doesn't hurt, and you mail it back, that unlocks the volume they need to make this a $100 million business.
Then you have testosterone, hormonal therapy.
The performance metrics they shared here were incredibly strong. They claimed 95% of testosterone users see an increase in levels, with an average increase of 80%.
Wow, and an 80% bump.
That is real efficacy. And in the wellness space, efficacy equals retention. If a guy feels stronger, has more energy, and sees the numbers on his blood tests go up, he isn't canceling that monthly subscription.
And menopause. This is a massive, historically underserved market.
Huge, and historically ignored by mainstream digital health. By aggressively addressing this, they are deepening the hers side of the business significantly. It helps balance the demographics of the overall platform.
So the overarching strategic shift here is moving from reactive fixing an immediate problem like hair loss or ED to preventative and proactive, longevity and overall health maintenance.
Which structurally increases lifetime value. A customer treating a chronic condition or actively managing their hormones is a customer for years, not months. It stabilizes the revenue base and makes it way less sensitive to economic cycles.
But let's zoom out. Because while they are building these new verticals at home, they are also buying an empire abroad. We have to talk about the international land grab, the Eucalyptus deal.
This was the real headline grabber of the print. Hims is acquiring Eucalyptus for up to $1.15 billion. That is a B for billion.
That is a staggering check for a company their size. $240 million upfront cash, and the rest in earnouts through 2029. Who exactly is Eucalyptus?
Think of them as the Hims of the Southern Hemisphere. They are a digital health platform totally dominating Australia, and they are growing incredibly fast in Japan and the UK right now.
What kind of numbers are they doing?
They have a run rate of roughly 450 million Australian dollars, and they're seeing triple-digit growth.
And there's a personal connection here that management brought up, right?
There is. Andrew Dudum, the Hims CEO, has known Eucalyptus founder Tim Doyle for years. They are culturally aligned. This isn't some hostile corporate takeover. This is a marriage of like-minded disruptors who see the market the same way.
So this immediately adds Australia and Japan to the map. And it strengthens the UK and Germany, where they already had a foothold with the previous Zava acquisition.
Japan is the absolute sleeper here.
Why Japan?
Japan is a massive consumer health market, very brand conscious, and historically very hard for U.S. tech companies to crack organically. Buying a team that is already winning there is a smart, albeit expensive, shortcut.
But let's talk about the financials of this deal. Because management was very clear on the call, almost painfully clear too. Analysts do not expect margin expansion from international for years.
That was a warning shot across the bow for the margin purists. They explicitly said growth is greater than margin right now. They plan to run international markets at or near break even to maximize customer acquisition.
So they are actively going to burn cash, or at least not make any real money, in these foreign markets just to grab land.
It is the classic Amazon strategy from the 2000s. You run break even, you reinvest every cent of gross profit back into price or marketing, and you secure total dominance in these massive total addressable markets.
It's a bold play.
It is risky because it delays the profitability story for the consolidated company, but it dramatically diversifies them away from U.S.-specific FDA risks.
Right. If the U.S. FDA bans compounding tomorrow, Hims still has Australia, Japan, and the UK growing at triple digits.
Exactly. It's a geopolitical insurance policy as much as a growth strategy.
It's a hedge. A very expensive hedge, but a hedge nonetheless. Now, all of this, the labs, the personalized pills, the international shipping it, requires serious infrastructure. You can't just do this with a laptop and a slick marketing campaign. Let's talk about their operations and what they call the moat.
This is where Hims separates itself from the generic telehealth startup crowd. Hims isn't just a website connecting you to a doctor anymore. It is a full-blown logistics company now.
Give us the scale.
They have 1 million square feet of operational footprint. That includes pharmacy, labs, and research and development facilities.
They invested $300 million in facilities over 3 years. That is real steel and concrete.
It is. And that vertical integration is crucial to the bull thesis. It allows them to do things others simply can't do at scale. We talked about personalized pills, mixing substrates, combining a heart medication with an ED medication in one single pill, or adjusting dosages specifically for your body weight.
Which you can't just order off a shelf.
Exactly. You cannot do that efficiently if you are outsourcing everything to a third-party pharmacy. You have to own the manufacturing line.
And then there's the tech layer built on top of the physical layer.
Right. They have AI-supported readouts for labs. They mentioned proactive messaging, these automated nudges, causing a 50% increase in weight logging among users.
That is behavioral science at scale.
And electronic medical record abstraction to help their providers move faster and see more patients safely.
Why does all this infrastructure actually matter to you, the listener, trying to value this stock?
Because this infrastructure allows them to produce that personalization at massive scale. A generic competitor like Amazon Clinic or a local corner pharmacy can give you a generic pill, but they struggle to give you a custom compounded pill with your exact dosage mixed with your specific supplements delivered to your door with an AI tracking your weekly progress.
That is the moat.
Yes, it's very hard to replicate cheaply.
So they are building a fortress. But right now, the market is storming the gates. Let's move to investor context and market signals. The stock has been absolutely hammered, down 50% in a month, down 78% in 52 weeks. It has been a brutal ride for long-term shareholders.
It has been a total capitulation. The market is effectively ignoring the beat on EPS and focusing entirely on the guidance cut and the regulatory fear. This has become the ultimate show-me story.
They don't trust the timing excuse.
Investors simply do not trust the timing excuse regarding the shipping revenue. They need to see the $65 million actually come back in Q2 and Q3 to believe it wasn't lost demand.
And the sector backdrop isn't helping them either. Digital health is crowded, and investors are terrified of regulatory uncertainty.
That is the phrase of the year, regulatory uncertainty. The FDA cracking down on compounders is the nightmare scenario. Right now, Hims is trading like a risky regulatory play rather than a tech compounder.
But the multiple has compressed significantly.
Because the market is pricing in a binary risk, what if the U.S. weight loss business goes to absolute zero?
So let's cleanly lay out
the
bull case versus the bear case for you.
The bull case is straightforward. The market is severely overreacting. If the Q1 issue is truly just a $65 million timing shift due to 503A compliance, and if labs and menopause scale to $100 million each as management predicted, the stock is deeply undervalued relative to its growth rate.
You are buying a company growing top line at 28% with positive EBITDA for a fraction of what it used to cost.
Exactly.
And the bear case.
The bear case is that the timing excuse is a clever cover for structurally slowing demand. If GLP-1 revenue collapses due to regulation and these new verticals like labs and menopause don't ramp fast enough to replace that lost revenue, the core growth story breaks entirely.
And on top of that, the Eucalyptus deal adds integration risk.
Merging billion-dollar companies across oceans is never easy. If they stumble on international integration while the U.S. business slows down, the PE multiple will contract even further.
It is a high-stakes poker game right now.
Yeah.
You have to decide if management is bluffing about the timing or if they're holding a royal flush with the international expansion.
Precisely. It all comes down to execution over the next 12 months.
All right. We have dissected the numbers, we have analyzed the strategy, and we have sufficiently scared everyone with the regulatory risks. Now is time for the part of the show where we throw caution to the wind. It is time for the This is Not Financial Advice segment.
Disclaimer time. We are not financial advisors. Do not do this. This is for entertainment purposes only. If you lose money, do not call us.
Seriously, don't. But if you were a hedge fund analyst pitching a wild, outrageous, yet somewhat plausible trade to your investment committee based on this exact earnings call, what is the pitch?
Okay, here is the pitch. I call this the pre-diabetic arbitrage.
The pre-diabetic arbitrage.
Yeah.
I like the sound of that. What is the actual trade?
The trade is this. You go long Hims and you short the back end of the failure chain. Specifically, you short the dialysis industry. Companies like DaVita or specific hospital REITs that rely on chronic end-stage renal failure.
Okay, walk me through the logic. Why are we shorting dialysis?
Hims stated tonight that 70% of their lab users are finding treatable metabolic issues before they become catastrophic. They're finding the prediabetes, the high cholesterol, the hormonal imbalances early.
Right.
They are effectively front-running the entire U.S. healthcare system's diagnosis engine.
They are catching the customers at the very top of the waterfall.
Exactly. You go long Hims as the ultimate preventative filter for the wealthy and middle class. If Hims succeeds at scale, fewer people crash into end-stage renal disease or late-stage cardiovascular failure 10 years from now.
Because they got fixed on the app.
Right. Hims becomes the pre-crime unit of healthcare, stopping the wildly expensive diseases before they happen.
So you are betting that Hims effectively steals the future customers from the chronic care industry by curing them or managing them before they get sick enough to ever need a dialysis machine.
Correct. It's a fundamental bet on prevention over cure. And here is the hedge fund twist to make it really spicy. You pair this with a long yen position.
Long yen. Why bring currency into this?
Because of Eucalyptus. The acquisition makes Hims a stealth play on the Japanese consumer health market. If they succeed in Japan and the yen strengthens, you get a double kicker on the earnings translation when they report back in US dollars. It's a macro currency hedge overlaid on a micro healthcare thesis.
That is outrageous. It is incredibly complex, and it is exactly the kind of 4D chess that gets you laughed out of the room or promoted to partner. I love it.
High risk, high reward. That's the game.
All right, let's wrap this up. Give us the final recap for you listeners driving home.
Here it is. Financials beat on EPS, soft on revenue guidance. The reason a $65 million shipping cadence headwind plus a massive Super Bowl marketing spend.
The big bet.
$1.15 billion for Eucalyptus to conquer Australia and Japan, and the strategic pivot moving aggressively away from GLP-1 regulatory dependence toward labs, hormones, and proactive preventative care.
Management compares themselves to Netflix and Spotify disrupting content. They think they are building the future of health consumption. But right now, the market is treating them like a walking regulatory liability.
2026 is the year we finally find out the truth. Are they a truly scalable tech platform, or are they just a glorified online pharmacy with a really nice app? The answer lies in the execution of this pivot.
We will definitely be watching. Keep your stops tight and your shipping cadence tighter. We'll see you next quarter for another deep dive.
Good night, everyone.